Welcome to this explainer. Today we're doing a deep dive into how global spirits giant Brown Forman navigated what you could really only call a completely tumultuous fiscal 2026. We're going to look right past the headlines and use the actual data to figure out the underlying mechanics of a major beverage alcohol company that's trying to operate in a highly volatile global market.
So let's jump right into this by asking the million-dollar question. Can a legacy company actually handle a declining global market? Well, as we unpack the financial results for the maker of Jack Daniel's, you'll see the answers are surprisingly complex. It's not just your standard, simple story of rising or falling profits. It's a much bigger story about shifting consumer habits, global economics, and some pretty aggressive corporate restructuring.
Here's our roadmap for today. First, we'll cover top-line FY26 results. Second, brand portfolio performance. Third, global market shifts. Fourth, financial stewardship and cash. And fifth, the fiscal 2027 outlook. Let's get right into it.
Starting with Section 1, Top-Line FY26 Results, Navigating Macroeconomic Headwinds.
Now, at first glance, this earnings report looks pretty tough. Honestly, it's the kind of numbers that might make you want to pour a stiff drink. Reported operating income for the year was down 10% to $1 billion, and diluted earnings per share decreased by 17%. But there's actually a whole lot of strategic maneuvering happening beneath the surface here, and that tells a very different story about the overall health of the company.
In fact, if you listen to President and CEO Lawson Whiting, the company ended up beating its own expectations. How? Well, it was driven by some really careful innovation and a massive strategic cost restructuring initiative. It's a brilliant reminder that in business, expectations and execution are honestly just as important as the raw percentage drops. The core business model showed some incredible resilience.
Just to give you a real sense of the sheer scale we're talking about here, we're looking at $3.9 billion in reported net sales for the full year. It's a massive operation. But to truly understand how that $3.9 billion compares to the previous year, we have to look at two totally different metrics.
And here's where it gets interesting, because this is a crucial distinction. Reported sales dropped by 1%, right? But organic sales actually stayed totally flat. So why does this matter to us? Because reported sales include absolutely everything, including the negative impacts of foreign exchange rates and the selling off of certain brands. But when you strip away those factors, like currency fluctuations and recent divestitures, their organic net sales were completely flat. That basically means their core ongoing business held its ground perfectly.
Moving right along to Section 2, Brand Portfolio Performance, the Winners and Losers.
The company definitely faced some serious, highly specific headwinds this year. A lot of that net sales decline came from shedding their relationship with Korbel champagne sellers, plus the end of a transition agreement for the Sonoma-Cutrer wine brand. And on top of that, they experienced lower volumes for their absolute flagship classic Jack Daniel's Tennessee whiskey. Those are some incredibly heavy anchors weighing on the portfolio. But check out this wild contrast. While the rest of portfolio completely tanked by 31%, largely due to those brand drop-offs we just talked about, the ready-to-drink category actually surged by 11%. Whiskey also managed to squeak out a 3% reported increase. That ready-to-drink surge carried a massive amount of weight for the entire company, which just goes to show that consumer convenience is an absolute powerhouse of a market force right now.
All right, Section 3, Global Market Shifts, Finding Growth Abroad.
Geographically speaking, the map is definitely shifting underneath them. The U.S. market actually shrank by 7%, mostly driven by those lost brand relationships and the lower Jack Daniel's volumes. Developed international markets were totally flat during a really tough economic environment. But emerging markets? No way. They are up a massive 14%, fueled by incredibly strong growth across places like Turkey, the United Arab Emirates, and Brazil.
And you know what a huge specific driver of that emerging market success is? The New Mix brand down in Mexico. This ready-to-drink brand saw an explosive 41% reported growth and 33% organic growth. They are gobbling up major market share as the ready-to-drink category rapidly accelerates in Mexico. It absolutely proves that having the exact right product in the right emerging market can completely offset declines in your older legacy territories.
Which brings us to Section 4. Financial stewardship and cash, the silver lining.
Okay, before we throw some more numbers at you, let's just do a quick refresher on free cash flow. It's a make-or-break metric for any business. Basically, it shows the actual, usable cash the business generated after paying to maintain all its capital assets, like its distilleries and equipment. It's literally the lifeblood of corporate flexibility.
So here is the absolutely crucial takeaway. Even with a 10% drop in overall operating income, they used incredibly strict, disciplined working capital management to generate a massive $1 billion in operating cash flow. That is an increase of over $400 million from the previous year. Honestly, it's a total masterclass in pulling cash out of a business, even when top-line growth is totally stagnant.
So what exactly did they do with all that cash? Well, they used that financial muscle to return $827 million directly to their stockholders. They distributed $427 million in regular dividends and used another $400 million for share repurchases. Keep in mind, we're talking about a company that has paid regular quarterly cash dividends for 82 consecutive years. Cash generation exactly like this is how they managed to keep that incredible streak alive.
And finally, let's look at Section 5. Fiscal 2027 Outlook, what lies ahead? Management is not sugarcoating things here. They're laying out some pretty stark, realistic expectations for next year. They're predicting flat organic sales once again, and they actually expect organic operating income to decline by 3 to 5%. Why? Well, because macroeconomic pressures and geopolitical instability are continuing to weigh really heavily on consumer behavior, especially in developed markets. The hangover, it seems, just isn't quite over yet.
Which leaves us with this final, lingering thought to wrap up this explainer. Can their aggressive corporate restructuring and targeted product innovations, like the new Jack Daniel's Tennessee Blackberry, actually outrun a challenging global economy in the coming year? They've definitely proven they can generate massive cash in a down market, but fiscal 2027 is going to be the ultimate test of their new, leaner structure. Thank you so much for joining me for this deep dive, and definitely keep an eye on those emerging market numbers as we move forward.